Well, welcome everyone to the 8th market video from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here at the firm, and I'm joined again by Bob Paolucci, our founder and CEO. Welcome, Bob.
We're back, Julina.
We're back. So we had a great summer, and I think this is an interesting time to have another video because we were encouraged this summer by some of the upside that we saw in the markets. We've seen some recent retrenchment, and we thought it would be a really good time to address a few things. What's going on with the markets today? We want to talk about the volatility that is being led by the Fed and inflation conversations. We want to talk a little bit about what's going on in the economy, and finally, some potential what could go right, what could go wrong scenarios, if that's fair.
Sounds wonderful.
All right. Well, then I guess with that said, I'll let you kick it off, Bob, with with some information that we have had in the past, talking to our clients about the volatility. We have a slide here to portray a little bit the drawdowns that we've seen, if we can maybe go through this one more time and where we are as of this week.
Absolutely. Yeah. And Julina, before we hit the record button, we were talking about this being, I think, our 8th video we've done this year. What that tells you is, number one, the market's been volatile. Number two, you might be seeing repeat slides with updated information. Number three, there might be some changes coming, potentially from the Fed to the economy to the markets, so on and so forth, right? That's really when and why we do these things. Going with one of the slides you may have seen before, if you've listened to this, watched this, and downloaded the slides, it's an index drawdown chart really showing for the year, the big three indices, the S&P 500, right? The 500 largest U.S. domiciled companies in the world, sorted by market cap, down 19% through Friday. The NASDAQ composite index, which is filled with technology, healthcare, mostly, again, sorted by market cap, largest to smallest, down 27% year to date. And the Russell 2000, which is small cap U.S. companies sorted by market cap, is still off 20%. Where they were, the S&P was down about 24.5%. It reached that level mid-June. The NASDAQ was down 33, again, mid-June, and the same thing for the Russell 2000. So where the market is, it's higher than where it was. When you look at the underlying stocks, companies in these indexes, the average stock drawdown in the S&P is down 30. The average stock drawdown in the NASDAQ is down 45. This is the average stock. And the average stock drawdown in the small cap index is down 44. That's quite a sell-off. What's left to sell, right? Meanwhile, earnings on the S&P 500 are up 11% halfway through the year. So rarely do you have an up earnings year and a down price year. Earnings momentum is still pretty good. Even the companies themselves, they've guided down a little bit, but that's to help them jump over the bar of expectation in the future over the next couple of quarters. But we think earnings still look pretty good there. According to their revisions, will still be good, just not exceptional. So we'll very likely end the year with positive earnings. Not sure where we'll end the year on the market, but the market and earnings over time tend to sync up pretty tightly. Right now, they're anything but synced up. They're actually completely out of sync. But so is the economy, the inflation data, the world, the Fed. Everything and everyone is really still out of sync. Mostly pandemic related. It created a choppy environment for data, reporting, supply chains, many other things. So,
and I think one of the most important points on this page, Bob, that you just commented on is that despite the fact that the markets have pulled back in a way that's very uncomfortable, we are not back to where we were at the June low.
That's right. A quick sell-off when you're on vacation is the best way to have a sell-off. A slow grind where you just continue to feel punished month after month after month. It's draining. But the market has really been sideways now for 3 months, 4 months, volatile, but sideways. And We think we might get a few more months of that, but it might start to arc up sooner rather than later.
Yeah, absolutely.
We'll
And
talk about that going forward.
yeah, we'll talk about that in a couple of slides. The other slide that I wanted your comments on is, the question that we get as financial advisors in general is, well, what if I just go to Vanguard?
We're going to address the infrequent, but frequent enough comment of, well, can't Vanguard do better? Well, technically, no, because they don't do anything for you. They just put you into various indexes. So you do it yourself. So what we're showing here is, Vanguard does have 3 static asset allocation funds that you can invest in. It's called their life strategies funds. And what they use are their underlying funds to create a portfolio. So they created 60-40 stocks to bonds, 50-50 stocks to bonds, and a 20-80, 20% stock, 80% bond portfolio.
In other words, they're managing it all for you.
They're managing it all for you. It's static. You own everything. You own every asset class. It's all cap weighted. So your international exposure on the equity side is about 40% of the equity, which is high, but not uncommon in the industry. You own all the bonds, good ones and bad ones. You just own everything. Sometimes it's easy to talk about things and say, well, I should just invest in this and just invest in that. Really? What if we told you that over the past 3 years, your returns would be 0? In the past 5 years, your returns would be close to 0. Would that change your mind? So here we are showing you Vanguard stuff, which we have access to, and we invest in some of their stuff, but we don't follow their strategies. It's because it's just a risk strategy. There's no attempt to do anything different. You just own a bunch of risk and you deal with how it does. This listing of very popular Vanguard investments, when we were doing this, something really popped out to us. Their bond investments are doing worse than their stock investments. And that makes sense because the bond market is down as much, and in some cases more than the stock market. And that's not something you read about. That's not something you hear on TV. And that's not something really being promoted or discussed. It should, because most investors have some allocation to bonds, as you typically should. But if you just own some of these bond indexes, look at the Vanguard long-term bond ETF, down 25% this year. And that's through Friday.
Amazing.
Annualized for the past 3 years, it's down almost 5% a year. So you've lost just about 15% over 3 years, but slowly. And if you've held it for 5 years, what we would consider a long time frame, you're down 1% cumulative net of dividend. So you've made no money. So you really got to know what you're doing in these environments. Vanguard, which is the equivalent of just kind of throwing darts on a board, here's an easy way to lose a lot of money quickly and slowly. And we just illustrate that to you so you understand that it's a wild environment out there.
And I think you're stressing what we have said in some of these past 7 other market videos this year, is that there really has been nowhere to hide.
Yes, and Vanguard is more exposed to what's going on in the market than probably any other firm, because their exposure is market risk, whether it's bond market risk or stock market risk. They just own risk. You own everything, you own the markets.
You own the market,
yeah.
Right?
So, in Julina, we were chatting earlier about how bad days, all companies are guilty. They go down together. Such a highly correlated sell-off. And then when they rally, they're all being rewarded together.
Sure.
Almost the same. And just so you know, that's not how it should work. But because of over-indexing and massive amounts of money being thrown into indexes blindly, that's what it creates, a very highly correlated, everything goes up and down together environment. Sure. So you are seeing the other side of indexing and what it can do.
No, exactly. And what about now the flip side? On the flip side, We also on occasion get the question, well, what if I just gone to a hedge fund?
Oh, a great teed up question here, Julina. So, hedge funds are private. There are some hedge fund indexes that we look at that show how miserable these funds have done over every measurable period of time. Most of it's the 2 and 20 fee structure, which means the hedge fund manager makes all the money on your money, and then you don't make any money. But you can brag about being involved with a hedge fund. So SPACs are much easier to track because they're publicly traded. A SPAC is a special purpose acquisition vehicle. In English, it's a publicly traded hedge fund. Most of the big hedge fund providers have now come out with these SPACs. And what they do is they take investor money, they put it in a pot, and then they look for mergers and acquisitions, they look for takeover candidates, they look for investments that they can invest in to make you some money. As you can see, this is through the end of July. SPACs are also down 50%.
And I think this is an important note because the money that has gone into SPACs over the last several years is extraordinary, right?
Unbelievable.
Yeah.
Unbelievable, the amount of money. And look, these hedge fund managers, fund companies, they have great marketing skills. If they were, if they're charging what they're charging, it's in their best interest to attract as much money as they possibly can. Use the glossiest paper, have the loudest voice, try to use the best spin to get you to invest into a pot of cash, mind you,
right,
that they could work their magic on. And it looks like their magic is gone, but was it ever really there? So
no, thank you for going through that. And I'd like to go back to address the volatility that you mentioned earlier, because as if the markets haven't thrown enough concern to us as investors this year, there's another key item that's coming up here in the fall that the media hasn't quite yet started to talk about. Can you address the upcoming midterm election and what we found coming out of it?
I thought you were going to talk about my birthday, but okay, the midterm elections. I'm sorry, I was confused. Yes, I think we all started hearing these political attack ads. They're more flagrant, meaner than ever, louder than ever, and there's so many of them. It must be midterm election time. So, what's fascinating here, Julina, we've had this chart up before. I believe we posted this. We got a lot of questions about it. What you have here is a blue line that shows all market years since 1950, sort of the average monthly pattern in the normal path, right? How it generates return. That's a calendar year. And then we pulled out only midterm election years. We pulled it out, and Fidelity was kind enough to create this illustration showing all years, midterm years included, versus only midterm years. And wow, what a difference. Interesting. From the beginning of the year, in a midterm year, it typically starts the year off on a bad note, has a little comeback between February, March, and April, goes sideways yet volatile, declines in May and June, recovers in July and August, bumps around a little bit in September, could retest the lows between September and October, and then in a volatile fashion, starts to move up.
Correct.
Well, up and down, but the trend tends to be up.
And this is irregardless of the win, right? This is irregardless of whatever.
It doesn't matter. Yeah, it's just midterm election years in general. And you could see, wow, the red line is much more volatile than the blue line. And what stands out to me is the red line looks like this year so far, almost identical.
Choppiness is not new in a year like this.
Yeah, but the path and the monthly cadence looks very similar to this year.
Sure.
Well, if it continues to look like this year, then it means we have a little bit more of a volatile sideways move before we start to have a volatile upward arcing move.
Mm-hmm.
Interesting. Just an observation.
Right.
I'm sure we'll revisit this over time, but we wanted to put it up here because it's eerily similar to what's happening this year.
And is it fair to say that the markets typically respond positive after a midterm election year just because the markets have an anticipation of what to expect going forward?
Correct. I mean, the going back over all data that we can measure, the capital markets, the bond market and the stock market, they tend to react well to divided government. It doesn't matter how it's divided, who divided it, whether it's left-leaning, right-leaning. If it's divided government, you have a good environment for the markets going forward.
Great. And we know obviously the choppiness this year has been higher than normal. And if we can talk maybe a little bit about what's been driving that volatility, specifically with the Fed, their language, and what's been transpiring with inflation.
Sure. Yeah, I mean, the driver of most of this is really the entity that controls the cost of money and how much of it flows out is allowing less to flow out. They're not providing monetary stimulus, they're tightening, and they're making the cost of money go up. What does that mean? That means interest rates are rising. It costs more to finance a house, finance a car, finance anything. And, that adds up over time. It's what the Fed wanted to do. Having zero rate policy, that was supposed to be temporary. Fast forward a decade and a half later, we're finally doing something. Are we doing the right thing? Are they doing the right thing? We'll see. But, zero interest rates is wrong. And we know 10% interest rates are wrong. Is something in between right? I think something in between 5 and 0 is probably the right number. The Fed might be over tightening here, knowing that they can, turn the radio knob back a little bit in the future with a rate cut. I really hope they don't get in that position. I hope they stop after this week's increase, which we believe is very likely going to be about a 0.75 of a point increase. That would bring Fed funds rate, short-term rates, up to about 3.25%. The bond market has about 4% priced into it. So the bond market has one additional 75 basis point increase already priced in. Could be right, could be wrong. I hope it's wrong. Fed was on vacation in August, and that delay allowed them to observe the slowdown in the economy that they created. One, by using their words, two, by tightening, making the cost of money go up, and allowing less money to flow. So it was great for them to take a breather to observe the data, right? Because they are saying they're data dependent.
Yes.
And the more time they have, the more data they have. The more data they have that looks negative, the less they're going to do. So I really wish this Fed would just take a break for a little while to really observe what they've done.
I think that's the concern of a lot of economists, correct?
Yeah, we internally for months have been saying this, and now you have most big firms saying this today. Not 2 months ago, not 3 months ago. Most big firms are saying it today. Hey, the Fed is probably making a policy mistake if they increase rates by too much here. They don't even think the 75 basis points is needed. We don't either, but they might do it. So if they do any more, the good news is, if they do any more after September, the good news is we think they'll cut. And if they cut, that has a 2011, 12, 13, 14, 15, 16, 17, 18, 19 vibe to it, which means they will stimulate by cutting, right?
Meaning that they were so aggressive in the tightening, which is what we're talking about right now, that they have to unwind some of that and they start cutting.
Exactly. And we know that lower rates will push bond prices up. So your bonds will make a lot of money really quickly. And we know that stocks, which are being pushed down because of higher rates, well, if rates go down, stocks will go up. So either way, we think we'll have a decent environment. I think the best environment would be if they stopped increasing rates after September. So the setup here, just so everyone knows, is they have their meeting this week. Whatever they're going to do, they will announce this Wednesday at 2 p.m. And then they go on vacation again. They take a break. They take October off, and then they meet again to decide what they're going to do and tell us the end of November.
Exactly.
And then they meet again in December. I would look to the Fed's language to change here. saying something like, we've seen a change in the data, so on and so forth. But this chart up in front of us, this one's very important. I should talk about it.
Yes, please.
Okay, so inflation, when you hear the inflation number, it is the current month's inflation number plus the prior 11 months glued together to give you a cumulative number. That is your inflation rate for the past year. It's not for the next year. It's not for the past month. It's for the past year.
And it rolls every month.
Yeah. The Fed can't do anything about the past, meaning they can't change the October of last year number. It already happened, but it's still in the number.
Correct.
So every month that we get a new number, the old month rolls off. New month rolls on, old month rolls off. You can see pretty clearly that for the next 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, probably for the next 10, 11, maybe even 12 months, the numbers that will roll on should be significantly lower based on the underlying data. So if you just take the past 3 months and annualize it forward, you have an inflation rate that is 5.6 instead of the quoted 8.3 number. So just taking the most recent data, forecasting forward 12 months, you have a much lower inflation rate. We believe
this is such an important topic because the volatility of the markets alone last week were driven from this number, right?
Yeah.
August of 22 up 0.1. And all of the attention from the media was it was hotter than expected.
Yeah, because the expectation is it would come in at either 0 or negative 0.1.
Right.
But the month that rolled off was a higher month. It was a 0.4.
Exactly.
I believe. So inflation went down. Now, this is media candy right here. Eventually it won't be, because no one will be talking about it when it's at 2 or 1%. But they talk about it because it's a big number, right? And everybody listens and everybody clicks, which means you'll get ads that pop up all the time. I wish they would do everyone a service and explain how this works, because it's very likely that the Fed is looking at the most recent data and annualizing forward, right? Because they know they can't predict the future, but the damage that they have created, the demand destruction that they have created, which indirectly impacts inflation, is showing that it has worked very well.
And I think the other important point too is that when inflation to fall, it can't drop like a stone by purely its definition.
It can't, because it's measured every month, but
Yeah.
but they look back at the prior 11 months to give you an annual number. So time is what's needed here.
Yeah. And I think that you have another visual that also helps explain a little bit more what we've been seeing.
Yeah, for fun, let's take all of the measurements of inflation, which is headline CPI, PPI, which is the producer price index, and PCE. Oddly enough, that's the one the Fed uses. And they're all headed down pretty quickly, I would say.
Mm-hmm. As quick as it can.
Quick as you can. Monthly, every month. So it's coming down pretty quickly.
Yeah. And if, oh no, sorry, did you have another point on
Well,
this?
not to scare anybody listening, but the Fed is guessing, because they can't predict the future. We can't predict the future. But if you look at the trend, hey, what the Fed has done is working, to bring demand down, indirectly bring inflation down. And they have to be careful here. You want lower inflation. You don't want deflation. Deflation is a different problem.
Correct. Maybe to give our clients an idea of some of the research we've been doing with this topic, you have a couple of other slides that talk about inflation going the other way, if you want to quickly touch on that.
Sure. Okay. So this is the data. So for your reading pleasure here, we've included the top 25 items that are declining, right? From a percentage decline standpoint, sorted by largest decline to smallest decline, but they're all declining. For fun, we also put the weight in the inflation calculation in there to the right, so it shows you how meaningful it is in the calculation. So we listed the top 50. No more. just 50. When you get this
25
video,
are on this page.
25 are on this page and 25 are on the next page, I believe.
Correct.
Yeah. So when you get this video, we've included the slides and you can see for yourself the data that we're talking about. Now, we also include this because for months, I wouldn't even say for months, for 2 quarters, right? I believe in February, we went out on a limb and said that sometime this summer we would likely see inflation peak. I believe we saw it peak just about any way you can measure it. And here is the data supporting that, number one. Number two, this is some of the underlying data that we were looking at. This is a condensed view that got us to our call of inflation will come down in the summer. And when it starts coming down, it will probably not stop.
Absolutely. And
So-
as much as I think, fruit is important because my family eats more fruit than any other food item in our house, it is important to see that there are some larger items such as oil, gasoline, car and truck rentals, airline tickets that are on this list as well.
That's absolutely right.
Thank you.
You've got it. And also the words of the Fed are a tool. The way they were talking, saying that we want to create some unemployment. It's amazing, right? We want to create some unemployment. There are too many people employed. Wow. Housing is too hot. Wow. Okay. Well, their words are really effective. You've had less consumption, you've had higher rates, and you've had the Fed, really still have the Fed talking tough. And that has made a pretty significant difference when it comes to demand.
Absolutely.
So,
and if you can talk about the economy a little bit, because there were a couple points that you thought were important to address today.
Yeah, so the next 2 slides. So really the 2 items that are hanging out there that are very strong that the Fed is trying to do their best in harming, let's say, is jobs, right? So we've been talking over the past couple of videos here that there are 2 help wanted ads for every unemployed individual. And now that has ticked down to 1.95 help wanted ads for every unemployed individual. So at least it's off its peak. It's never before seen peak of 2. It's coming down. And I have a feeling over the next 6 months that will continue to come down. We were laughing, Julina, about the quits number. So it is what you think it is. When you look at that chart on the top right-hand side, it shows the amount of people quitting is going down. So when times get tough, and there are fewer jobs out there, your employees stop complaining and they start to love their job a little bit more and their paycheck and their benefits and, the little things that they have to do, the big things they have to do. They hug their job a little bit more in times of stress. It makes sense. So we're seeing in the job market what was very likely to happen. You're seeing layoffs are, at a figure that's near its all-time low. That will likely head up. Just based on the announcements of layoffs, whether it be Goldman Sachs or some of these other financial companies, most of technology, some healthcare, all of cryptocurrency, however big that industry is, and many other companies are starting to lay off a lot of people. That really hasn't even shown up in this data yet. It takes a little while.
Sure.
It takes a long time to hire someone. It takes a long time to detach, and those numbers haven't really been reflected yet. But you are seeing the quits number go down. Well, it's deceiving. There's been articles about these silent quitters, people that come to work and do nothing at work. So there's still some of that in the system, but that'll go away pretty soon.
Sure.
But you are seeing the amount of help wanted ads come down. So what does that mean? That means the Fed has made an impact. Are they waiting to make an impact, or they really want to see a big impact? Well, that'll be seen over the next couple of months. You might even hear it on Wednesday. So
okay,
that's why we bring it up, because this is one of the hot items with the Fed. The other one is the next slide, housing.
Yeah.
So housing is certainly slowing. New builds are slowing down. Inventory is changing. There's a lot less activity. Keep in mind, there are a lot of people that want to move. There aren't really a ton of homes available.
Sure.
So I think that will normalize over time, but this is very promising. So it has a lot to do with some regulation and low rates here. So what you're seeing is owner's equity in household real estate is through the roof.
Right. Okay.
And mortgages are not. There is an enormous gap between the average mortgage balance and the amount of equity in the average home. An enormous gap, one that we've never seen before. I bring this up because, I mean, we all remember 2006, 7, 8, 9, 10, and the lingering effects that we felt in 11, 12, 13, 14 in the economy, right? Created from a housing bubble, created from really bad mortgages that were, giving people 130% of their equity on a home that had an inflated value, and the homes went underwater, the mortgages went underwater, so on and so forth. We don't have that today. We have a tremendous amount of equity in real estate. Even if real estate prices come down substantially, you don't have an issue.
Exactly.
And part of that is we've had most of this country refinance high rate mortgages, and the ones that didn't, probably didn't have many years left on their mortgage, so they were paying mostly principal. So, if you have a high rate mortgage that has 20 years or more left, and you have no equity, that's unusual today. That was the norm in 2006, 7, 8, and 9. That's not the case now. There's so much equity in housing. And you can see the green chart here. We have never, actually, you have to go back to 1960 to find the level of equity as a percentage of equity in real estate. So housing is in really good shape. I would even argue that consumer net worth is in really good shape, because most individuals, probably nobody listening to this, but most individuals, their net worth is mostly their house. So if you have a lot of equity in your house, or you have equity in your house, you're in a pretty good situation.
Yeah.
If you have a mortgage, it's very likely you have a very low mortgage, a low interest rate on your mortgage. It does create a pickle if you need to refinance in a higher rate environment. If you need any help with that, call us. We will try to figure that out with you, for you. But you also don't have these crazy interest only mortgages that were very common in 07 and 08. You don't have that. You have a lot of conventional mortgages, principal and interest. If anything, just recently, 10-year ARMs have become popular, rightfully so. I think the interest rates will be lower a year or two from now than they are today. So it certainly gives people the opportunity to get into a mortgage without having to pay 6.5%. I believe that's the going rate today, where you can get a much lower rate. Then in the next 10 years, if rates drop, you can, refinance down quite a bit. So the whole setup in housing is much better. Housing activity has come down. A lot of the froth that we've seen over the past 24 months is starting to come out of the housing market, therefore price. But there's still a lot of a good amount of activity, and there should be a good amount of activity going forward. Less than we've seen, but more than we've had over time.
I would also say that looking at this green line, it's hard not to reference coming out of the financial crisis of 08 and how different this environment is relative to that.
Incredibly different. I mean, this is the most important slide that you can see if you want to make a comparison to 2008 to today. The other would be household net worth, which is very high. I think most investors forget, whether you're with us or some other investment firm, for the 2017, 2018, 2019, 2020, 2021 period, just the past 3 calendar years, if we go back, our investors on average probably made 50 to 75%, depending on how they were allocated.
Mhm.
And many investors, probably made 30 to, I don't know, 55% based on where they were in 3 years.
Right.
So they made well above average returns for the 3 years leading into this year. Our investors made a lot of money, way above what their allocation should have done leading into this. So to have a 15%, 14%, 12% ish pullback, it's going to be okay. You average out your past 4 years return, you're probably still close to double digits. You might even be high single digits. That's still really good. Really
Absolutely.
good. But this slow lingering decline that's not going away. It's annoying, and you have the media who is sort of pouring salt on the wound because they're, sending you clickbait and driving you crazy. On top of the political environment that we have, on top of the geopolitical environment that we have, on top of the, the still black cloud that is the remnants of the pandemic. Good times are ahead. I know it might not feel that way, but after every hurricane, the good weather comes. So we're almost there.
Absolutely. And that's been a message that we've been trying to convey all year, despite all this volatility. And maybe one of the last things we can discuss is part of the conversation that we had at our last investment committee that we time and time again, we tend to go through with each other, which is playing out the future scenarios. We play out the what ifs. So can we talk a little bit about that?
We sure can. We'll do it quickly.
I think this is one of the reasons it's so challenging to forecast the future, right? And so we try and spend a lot of time saying, all right, well, what can help the markets going forward? What can go right? And on the flip side, what can hurt the markets? What can go wrong? And to your point, there's always a long list. It's not to say that this year is any different. You always have those scenarios, but maybe just highlight a couple things.
Yeah, I think the biggest ones, right? And we have charts for this. I think inflation dropping. Why is that important? Well, the Fed might change their path. And those two things are very important here. We've seen a slide of what divided government will do for the capital markets. Divided government is typically a good thing for the capital markets. I think the likelihood of that is pretty high. COVID goes away. Well, how timely was that? We have this jotted down in our notes. President Biden on 60 Minutes last night mentioned that COVID is gone. So because I have it written down and he said it, I think we're going to go with that. The supply chain no longer having bottlenecks. Yeah, that was a January story, not anymore. Things are starting to sync up. Things are starting to work the way they should. The data is starting to change. That will support a Fed decision to do something different. That will be a very good thing. What can go wrong? The data doesn't change. Inflation ticks up. Okay. I would be hard pressed to find out what data that is. Just remember, housing slowly changes.
Sure.
We should be looking at that quarterly, not monthly. Don't get too passionate about it. It will change very shortly. The war with Ukraine intensifies and Russia intensifies. I don't know that will happen. I would say that's neutral. I don't know where that is, near the end, near the beginning. We don't know where we are there. Earnings, let's say earnings shock to the downside. They can, but keep in mind they just lowered the bar. So company CEOs and CFOs, big publicly traded companies, they know what their business is doing. And they know the level to downgrade to. They know where to bring your expectations low enough to jump over the bar to positively surprise you when they report their next earnings report. So I feel pretty good that they won't shock to the downside. Let's say COVID ramps up. Let's say COVID is not over with. If there are mass lockdowns, which I don't think we'll be able to pull off here in the United States without riots and potentially a civil war, that could happen. Will it happen? Who knows? Mass layoffs. Yeah, I think, in the Fed's quest to create higher unemployment, they risk creating way too much unemployment. But that's not really in their hands. That's in the hands of business. So I think they'll get it right there. So the other thing that could go wrong, the Fed remains hawkish with their language. I would say if there is one obvious thing that can go wrong, it is a Fed mistake. I can say that maybe they made a mistake with their plan to increase rates maybe too late. They should have started maybe this time last year. And they didn't. So it was all condensed into really the past 9 months, soon to be 10 months. They can make mistakes. They can over tighten. We will see.
Yeah, that's great.
So, but I am leaning on the what can go right camp very heavily. I think more can go right from here than wrong. And there's a pretty good setup. The other thing to be mindful of is we can buy securities at a discount. We can buy bonds with a significantly higher yield now. You know, a great environment for a new investor and new money. Just so happens to be a bad environment for people that have been invested. They kind of go hand in hand. So things look pretty good from here, in my opinion.
Yeah,
even though we're going to have some volatility.
I think it's also important for investors, even if they don't have new money, to remind themselves that if they have interest that's reinvesting, they're just buying more shares.
Correct.
Bob, thank you for going through all that. I jotted down a comment that you said earlier before we got onto the video. You said it's a symphony out of tune.
That really summarizes this year and the data, the media talking points, not being on the same page at the same time, or being on the same page at all. It's a symphony out of tune. We have all the players, all the instruments, all the stuff. Just nothing is syncing up.
Right.
And I think in a short amount of time, many things will be starting to sync up in a good way.
Yeah, absolutely.
So
and
more to come on that.
More to come on that. And I think the other thing is, despite all of the concerns that we continue to talk about in the markets and the economy right now, with the volatility, all eyes are on the Fed. And that's why it's so important.
Our eyes are on them too.
Yeah. And then I think finally, for any clients or investors that have been listening to our videos and we're maybe looking for a different message this time around, I think the conclusion is that there really is no different message than what we've been saying all year and trying to convey, and that we still remain optimistic. Markets can continue to remain choppy, but that's okay in the short term.
Yeah, I mean, the markets are at levels that we talked about now many times. They're actually now, they're still above their lows. I know it doesn't feel like they are, but they are. And, you know, the highs and the lows create the rails, that trading zone. That's where the market has been, you know, moving between. Right. And it just needs a little positive kick to get out of this trading range. And we think a little kick and a little bit of time is all that's needed.
Absolutely. Well, thank you, Bob, again for your comments. And I want to thank everyone for listening in. And as always, if you have any questions or concerns, please feel free to reach out to us here at Principal Wealth Partners.
Excellent. Thanks, Julina.